Welcome to this explainer on Alibaba Group, looking specifically at August of 2026. Today, we're focusing squarely on their highly anticipated Q1 FY2027 earnings report and the truly monumental strategic shifts happening right beneath the surface. Okay, let's dive into this. For the better part of the last 3 years, Alibaba was totally boxed in by this old narrative, heavily dominated by regulatory crackdowns and a heavily pressured, slowing Chinese consumer. But as we parse through the latest data today, that old narrative is officially dead. Under the leadership of CEO Eddie Wu, Alibaba has engineered a totally new strategic direction. We're now looking at an aggressive AI pivot, strict operational discipline, and a historic cloud spinoff.
Here's our roadmap for today's explainer. We're going to hit the narrative shift, unlock the cloud, check in on the e-commerce cash cow, review those buybacks, weigh the macro risks, and then deliver a final verdict.
Section 1. The narrative shift. Q1 FY 2027 earnings reveal a brand new Alibaba. When these numbers dropped in August, they told a very clear, very focused story. Overall revenue rose 8% year over year to 243 billion yuan. Now, an 8% top-line bump is solid for sure, but the real story is actually hidden a bit further down the income statement. Because the actual headline of the quarter, adjusted EBITDA, jumped 12%. So why does that matter? Well, it means their profit is growing significantly faster than their revenue. Management is literally squeezing more margin out of every single yuan they earn. It's a massive sign of operational discipline from Eddie Wu's team. They aren't just chasing growth at all costs anymore. They are laser-focused on profitable, sustainable growth. Section 2. Unlocking the cloud. The game-changer spinoff. This is undeniably the biggest structural event for this company since its initial public offering. In early August, Alibaba's board formally approved the separation of the Cloud Intelligence Group into a standalone, publicly traded company slated for the Hong Kong Stock Exchange. Now, what's truly interesting here is understanding exactly why management is doing this. It all comes down to defeating the conglomerate discount. This happens when a high-growth asset, like a cutting-edge AI cloud division, gets valued lower by the market simply because it's buried inside a mature, slower-growing parent company. By spinning off the cloud via a share dividend to existing shareholders, Alibaba is directly isolating this asset so it can finally unlock its true valuation. To see exactly how much value is trapped right now, just compare the numbers. Currently, Alibaba's core business trades at a forward price-to-earnings ratio of roughly 12 to 14 times. Meanwhile, comparable U.S. tech hyperscalers are trading at multiples of 25 times or more. The market has been severely undervaluing Alibaba's cloud infrastructure because it's just been lumped in with e-commerce. Management is essentially saying to the market, hey, we want this valued separately because you aren't giving us credit for it. And the growth profile of this soon-to-be independent unit is absolutely staggering. Cloud AI-related revenue didn't just grow, it literally tripled year over year. This drove overall unit growth well above 40%. More importantly, the cloud unit is shifting away from low-margin basic infrastructure hosting and moving aggressively toward high-margin AI model training. If you're a growth investor looking at this space, this specific catalyst is the primary engine for the next 12 months. Section 3. The e-commerce cash cow. A shift from growth at all costs to profitability. We definitely have to address the China commerce business, primarily Taobao and Tmall. The overarching theme here is a definitive pivot. In this latest quarter, they posted single-digit gross merchandise volume growth. Historically, that would have panicked the market. But today, that single-digit growth is entirely acceptable. Why? Because they have officially abandoned the race-to-the-bottom low-price war against competitors. Instead of burning cash on domestic price wars, they're treating e-commerce like a massive free cash flow generator to execute two exact steps. Step 1. Fund AI and international growth. They are investing heavily in logistics and just committed a combined $500 million to expand platforms like AliExpress and Trendyol into South Korea and the Middle East. Step 2, return capital to shareholders. This diversification strategy is brilliant because it slowly reduces their historical reliance on the mainland Chinese consumer. Section 4, buybacks and the Ant Wildcard. Massive capital returns and hidden value. Guys, this might be the most underappreciated aspect of Alibaba's current setup. We're going to look at their aggressive capital return program and then introduce a hidden wildcard sitting quietly on their balance sheet that could dramatically alter the stock's trajectory. $35 billion. To put that massive number into perspective, they could buy several entire S&P 500 companies with just the cash they've authorized for this buyback program alone. It is one of the largest in the history of global tech. They are aggressively repurchasing shares to offset stock-based compensation and meaningfully reduce the overall share count. And they're pairing this massive buyback with a 2.5% dividend yield, creating a very strong, very real floor for the share price.
Now for the wild card, Ant Group. The story of Ant Group has been an absolute roller coaster. Back in 2020, Ant hit its peak valuation right before its IPO is abruptly halted by regulators. By 2023, a massive restructuring process began. Now, in 2026, that regulatory restructuring is officially over. Ant Group has bought back shares from international investors at a $68 billion valuation, officially cementing its new status as a fully compliant financial holding company. So why does a $68 billion valuation for Ant matter to us today? Well, because Alibaba still holds a 33% stake in Ant Group. That stake represents roughly $15 to $20 billion in trapped value. But right now, the broader market is pricing that asset at exactly zero. It's been treated as a total loss. If Ant Group is permitted to restart an IPO, even at this much lower valuation, that is pure unpriced upside for Alibaba holders, which could easily trigger a special dividend or accelerate those buybacks even further.
Section 5. The China macro risks. The elephant in the room. Look, to keep this explainer completely impartial, we simply cannot have an honest analysis without addressing the reality of the macro environment. The absolute growth rates of the consumer business are still historically low, and consumer confidence in mainland China remains highly fragile and really dependent on government stimulus. Furthermore, the geopolitical overhang with US-China trade relations is extremely persistent. This geopolitical reality creates what we call the China discount. It's simply the risk premium investors demand for putting capital into a completely different regulatory and governance framework. You can see this risk clearly in the currency markets. There is a distinct inverse relationship here. When the yuan strengthens against the US dollar, the stock rallies. When the yuan weakens, the stock drops. Traders need to be acutely aware of this currency correlation because it drives a huge amount of day-to-day volatility.
Section 6, the final verdict. Asymmetric risk and reward. So the crucial point is this. Alibaba in August 2026 is fundamentally a show-me story. The underlying business, especially the cloud and AI infrastructure, is firing on all cylinders. The capital return is incredibly robust. Yet the stock is trading at a historically cheap 12 times forward PE because the macro environment is holding the valuation hostage. The risk and reward here is highly asymmetric.
As we wrap up, I want to leave you with 3 actionable takeaways to watch for in the coming months. First, keep a close eye on the November Q3 earnings estimates to see if that AI revenue continues to scale up. Second, monitor the yuan's strength against the US dollar to gauge that macro risk premium. And third, watch the technicals. The stock is currently bouncing between an $85 support and a $110 resistance. A technical breakout above $110 on high volume would likely trigger a massive wave of momentum buying. I want to leave you with this final, provocative thought. You've seen the fundamentals. You've seen the trapped value in the cloud spinoff and the Ant Group wildcard. You've also seen the undeniable geopolitical and macro headwinds. The ultimate question for your portfolio is this. Is the massive AI upside actually worth the macro risk? Can you stomach the headline volatility for a potential 3 to 5 year asymmetric payout? That's the reality of Alibaba today. Thank you for joining this explainer. Keep these concepts in mind as the next quarter unfolds and stay disciplined out there.